I'm going to show you how to get so stinking rich in 2023. You're going to probably make more money this year than you have ever made in your entire life. The people that are wholesaling, fixing, flipping, the old stuff that was working yesterday, that doesn't work anymore. But that has led to a tremendous opportunity that no one else is taking advantage of. I'm going to show you how to do it. So number one, we are focusing on on-market creative deals. We're not just trying to work with anyone. We're not just trying to work with anyone who just put their property up for sale. Maybe folks who missed the ship, they listed their property back in April and they were trying to take advantage of the market at its height. We don't want to work with those folks. We want to work with people who absolutely, and I'll underline this again, they need to sell their house. People who are relocating, folks who are trying to move to a different city, or they're trying to downsize, or go back to renting instead of owning because they can't make the monthly payments. Guys, there's a tremendous amount of people who need help right now. And you got to look back a year from today, right? A year ago, if 10 houses went up for sale, 9 or 10 of those sold, right? Today's market statistics, 10 houses go up for sale, 4 or 5 of them actually sell. But what happens to the other handful of folks? What happens to the other people who actually, of those 10, needed to sell their house? Those are the folks that we're working with, and we're helping them make that happen. We're creating win-win situations for all, and we're doing that by approaching it a little bit more creatively. So the second part of this is you want to structure great deals. We're not going in and offering lowball prices. We're not going in and saying, hey, look, we want to pay you 70 cents on the dollar, 65 cents on the dollar. We're not trying to take people's equity. In fact, we're offering at or above list price in many situations, but the terms just have to make sense. And it all comes into the way that we structure these deals. So we go in and we purchase properties by methods that you're probably familiar with. If you're not, you could probably search here on YouTube and you can find more information. But we do subject to, which is basically we purchase property subject to the existing mortgage. So a lot of people, they want to sell their house for 300 and they owe 300. Well, what do? They're going to be out of pocket if they try to sell that house, meaning after they pay a real estate commissions and closing costs, they're going to have to come to closing and pay somebody money to buy their house. Well, when we purchase property subject to, we take over those payments and they're able to walk with at least a little bit of money that otherwise they would have been out of pocket. So we do subject to deals. We do seller finance. Those are ones that people own the properties free and clear. They own a $300,000 house. They owe nothing against it, but they're giving me a loan to purchase their property. They don't want to be a landlord anymore. They're tired of fixing up the property, whatever the situation may be. They're financing into me and I'm locking in rates anywhere from 0 to 4%. And then we're also doing hybrid deals, right? Which is just a mixture of these two. But at the end of the day, why in the world would I buy properties at or above retail price? Well, the value of the property is not the price. The value of the property is what we plan on doing with it. How do we plan on making money on this property in the future? It's like buying a business or any other investment. I don't care what I'm paying for it as long as I have a plan to make money on that said investment. This is how you end up doing this. This is how you know that you have a good deal. We structure these deals at cash flow as long-term rentals. This is huge. As an LTR, that stands for long-term rental. Why do people want to own long-term rentals? Well, real estate over time, and history says that if you own a piece of real estate over time, that property will do something called appreciate, right? It's going to increase in value over time. Whether that be I'm buying it now and the prices are going down, do I feel like the price is going to eventually come back up? That's the benefit of purchasing real estate. So not only do folks enjoy that part of it, but there is this other thing called cash flow, which is passive income. You have a renter moving into a property, paying down your mortgage or your seller finance note. They're paying down that note for you, and you get the difference between what you're charging your tenant and what you had to pay your lender, or you have to pay whoever gave you the note on the seller finance. You're making that difference. So sometimes it's $200, sometimes it's $300, $400, $500, whatever. So you're getting both sides of it, right? You get today money, you get tomorrow money in the form of cash flow, you get appreciation. So that property is going to increase in value over time as you continue to hold it, and you get depreciation, right? Which is probably one of the cooler things of why someone would want to purchase a long-term rental. They get to take this, they get to write this off on their taxes. So if you have a CPA that's familiar with this, or you're working with other investors, this is the key to the game, because we can all go make more money. This is something that we've devoted a lot of time teaching folks. When you purchase a property at $200,000 or $300,000, typically anywhere from 15 to 20% of that, I can do what's called forced depreciation, and I can take that off on my taxes. So a $300,000 house typically is going to save me like $40,000 to $50,000 in my taxes. That's crazy. So if I'm able to buy these properties with $20,000 down or $15,000 down, I almost get to double that in depreciation in my tax write-off. Not only do I get all the other things, but I get that tax write-off, which is huge. That's how you structure a great deal. Number one is a long-term rental, we make sure it does at least that. Now, if you structure a deal that works as a long-term rental, guess what? You can also go in and do what's called wrapping the debt. If you're structuring these deals that cash flow, you could also sell those deals to other investors. You can make easy money by doing what's called a wholesale assignment fee, passing that off to another investor. Maybe you're not in the place where you have 20 grand or 30 grand to give to a seller, but there's thousands of other investors do, and you can start stacking up cash, so then you can start buying these. So no matter where you're at, you can make this work for you. And then of course, like what I was saying here with wrapping the debt, I can originate all of this up here, right? Sub 2 seller finance. I can originate a note, or I can take over an existing note or mortgage, and I can wrap that. It's called a wraparound mortgage. I can take these terms that I already have in place and I can give them to someone else, but I can arbitrage the interest, right? So if I'm paying 0 to 4%, I can go find someone and say, look, I got a deal for you. Come in, give me a down payment, and the note's going to be 8% or 9%. I'm going to make a 5% split between what's already in place and what I'm charging my end buyer who I'm wrapping the deal to, like a homestead buyer, owner occupied person's moving themselves and their family into it. So when it comes to a wrap deal, and I'm gonna break this here down in a second with some numbers so you guys kind of understand where I'm coming from, you have three pieces. You have cash now, you get cash at closing, you get cash flow, so you get money every single month with not being the owner of the property. Because guess what? When I wrap the deal and I sell it to someone else, I'm no longer the owner. Someone else is, so they're taking care of the property. And also get something that's called cash later. So typically a homeowner will stay in a house anywhere from 5 to 7 to 10 years. They won't stay in there 15, 20, 30 years on average, right? Especially if it's a starter home. Those are the three pieces of a wrap deal. So let's look at some numbers here of how this will affect you in 2023 and how you can make a ton of money right now. Well, number one, there's a ton of people who want to sell their house right now that can't, right? We've already established that. But if we can come in with creative solutions and structure deals that work as long-term rentals, that also work for other people that would love to buy those in cash flow, so you can wholesale those deals, or you could wrap these deals. Let me show you how much money you can make by doing that. In a typical deal, you have your house here, beautiful house. You have a seller, and when we go on market, we deal with a real estate agent. They're kind of the middleman between us and the seller, and we have us, the buyer, right? This is you in this scenario. Let's break down some numbers here, and I'll go slow, but I also think, it's super important that we touch on all of this. So number one, let's just say this property, they're asking $300,000. Now they owe a mortgage on this property. This is an important question to ask when you're doing this stuff. They owe a mortgage and it's $220,000. That's how much debt they have. When a seller says, well, how much equity do they have in this scenario? They don't have $80,000 in equity. Yeah, you can take 300 minus 220 and it's 80 grand, but they also have to pay fees, commissions, and all that. So they wouldn't really walk away with that much money. It's important that we also explain that to agents and sellers too. It's like when we come in and we buy this stuff, we're going to take on all those expenses, but like let's negotiate on how we can give you your price. We're giving them their $300,000 price. Their monthly payment on that 220 on that mortgage is $1175 PITI, which stands for principal, interest, taxes, insurance. Let's just say the next question that you're going to need to ask yourself when we're talking about cash flow, how much money could I make per month? I need to know what this house could potentially rent for. So in this example, I put rent as $1950 a month. So if they owe 220, they're trying to sell it for 300. I know that the monthly payment on that note is $1175. Well, as an investor, my first question is, how can I make this property cash flow? I need to know what it rents for. And in this example, it's $1950. The seller's equity I put here is roughly 60 grand, right? Taking into account like having to pay some agents and having to pay some closing costs, we estimate it to be somewhere around 60 grand as their seller's equity. When I'm trying to write in how much could I potentially cash flow in this deal, I like to put in my margin right here as 450. So I'm just going to put my margin. So $450 gives me enough room to say, leaves me some money to cash flow, leaves me some money to pay property manager, leaves me some money to put money aside for repairs. $450, a nice cushion when we're doing these numbers. So what I'll do is I'll take that rent rate and I'll subtract 450 to that rent rate, which gives me a final number of 1,500. So it tells me I can be all in here in this deal at $1,500 a month to still make sense of keeping this as a long-term rental, because it gives me my margin of $450, right? So let's break down these numbers and why this stuff matters. If I was to go in and purchase this property at $300,000, I would want to give them about $20,000 down, because I don't use my own money on these deals. I use private money, and typically private money is 12% interest. And an easy way to do the math, it's basically $100 a month for every $10,000. The way that we do this math is like, okay, well, the agent's going to want to get paid. Maybe I'll contribute $3,000 towards that. My down payment's 20. However, the seller wants to pay out their agents, up to them. But again, I'm contributing $3,000, doing my part. I'll come in unrepresented, so they don't have to pay a buyer's agent commission. But $20,000 down, I'm going to contribute $3,000 to the seller's agent, which is $3,000. Okay, so I'll add both of those things together. That gives me 23 grand, right? Adding 20 plus 3 gives me 23 grand, which we had established at 12% interest is $230 a month. So I'll take my 1175 and add 230 bucks. And I'm like, okay, well, what does that leave me? That leaves me roughly about 1400 bucks. So in order to keep it under this number here, how much can I pay the seller on their equity? Because I'm coming in with $20,000. I still owe the seller 40 grand on their equity. Well, I'm going to structure this as like, look, I'll give you $20,000 down. I'm going to give you $100 a month until it's paid in full. And that goes towards your equity. Typically, that's at 0%, guys. Super powerful. So I just bought this house with none of my own money, structured it in a way that I can still make it work as cash flow. And it's a good deal that not only I would buy, but a lot of other people would buy as well. You look at what this can net you on a long term, right? The long term on this net anywhere from 200 to 250 bucks a month. Crazy. Depreciation on this one property would be anywhere from about 50 to 55 grand. In appreciation, we don't know, right? How much could this property be worth in 10 years? That's the game we want to play. Now, with that being said, again, if you structure deals this way, they're also worth money to other investors. You did all the legwork. You went out and you negotiated this deal that would not only work for you, but I guarantee if it worked for you and you structured exactly this way, there would be thousands and thousands of investors who maybe they have access to more private money than you do, or maybe they have access to more resources, or maybe you're like, look, I don't want to deal with all this right now. I just need more cash so I can just keep going in my business. I'm very early on. I want more capital so I can invest that back in my business, pay yourself, do some stuff for you, actually pay yourself as a business owner, right? So you could always wholesale these off. This deal could be worth anywhere from 10 to 20 grand, depending on if you find the right buyer, but it's worth at least $10,000 just by calling someone who's listed the property that no one else could buy. So it's just sitting there, and just think about that as like a $10,000 check, $10,000 check, $10,000 check, 10,000. You get to the point where like, well, how many can I do? But they have to be structured properly. So yes, it's worth money. Finally, my favorite thing I love to do with properties right now. And I feel like this one strategy right here is what's going to separate people by millions and millions and millions and millions of dollars over the next decade. If you start putting deals like this together, and it's called a wrap. And that's what I alluded to earlier with like cash now, cash flow, and cash later. So let's look at the same scenario with the house that we negotiated. Let's just say we got these terms here. We did the 300K with 20K down, paid the agent, and all that good stuff. Okay, with that monthly payment, I could take those terms. Okay, so this is me right here with my piece of paper. That is my terms on a note, and I could say, look, I'm gonna go find a family who is like looking for a house that maybe they can get qualified for a mortgage. Do you think there's gonna be more people than ever right now who need to buy a house or looking to buy a house instead of rent that maybe they can't get qualified? Well, we can get them into houses by going ahead and negotiating deals on the front end and taking those terms and wrapping them to end buyers, just like this family here in this example. So what I'll do is I'll bump that price up a little bit to account so I can have a bigger down payment. Because remember up here, I gave my seller $20,000 down and I paid the agent 3 grand. I want to get a big enough down payment from my wrap buyer to wipe out all that money, especially if I use private money, which I do. I want to pay that back and then put some money in my pocket. So I put in this number as this example, $320,000 with a 40K down. Well, what that does is 40K down makes it to where I basically financed 280, which is what we did up here, right? We financed 40K plus the seller's mortgage. So with 40K down, where that money goes is, again, $29,000 is what I had to pay to enter. And what that is well, you said, well, Matt, you only paid $20,000 to the seller and $3,000 to the agent. Well, I also had to account for, I had to pay closing costs, title, attorney fees, title insurance policies. There's so much other stuff that goes into that. And I'm just estimating that to be, I'm going a little bit higher here. Typically it's like 4 to 5, but I went 6 grand in this example. Let's just say worst case scenario cost me $29,000 to enter. Well, 40,000 minus 29,000 is I just put $11,000 in my pocket that came from the down payment from these folks. Just because I got a little bit more creative and found the people that really, if they could have looked at the deal differently and they could have structured it on market, they could have went directly to the seller in the beginning. But because I did it and I went and I put this deal together, I can go give it to an end family. And this is how I'm going to make money. So I just made 11 grand, which have been very comparable to my wholesale fee, right? There's just a couple extra steps to make that happen. And then basically what I'm doing here is I'm financing the rest, $280,000 at 8.74% interest. And how I get that number is I use a tool called noteunlimited.com. You should check it out. They have a calculator button in the top right. Click on it. You can start messing with your amortization schedule, meaning on like, hey, how much can I charge per month right here that would still be comparable to the area rent? And that's how I work my way backwards to figure out my interest rate. So I don't want to go too high above area rent to make it where it's unreasonable. So for this example, you see where I did $2,200 a month principal interest. And the reason why I stuck at 22, because is it unreasonable for someone to pay an extra $250 a month over rent to actually own a home? And for the most part, the answer is no, right? And what I mean by principal interest is the property taxes and the insurance gets passed off to the end buyer. And I can do more. I have way more videos coming. If you want to see more videos on wraps, please comment below that you would like to see more videos on wraps. I can break down so many deals on this, but the concept is still the same. The property taxes and insurance passes to the end buyer. I try to keep it affordable around area rent and say, okay, cool. Well, if I'm financing them $280,000 at 8.74% interest, so I just created a gap between what I have to pay to my seller, right, and what I have to pay to the mortgage company that purchased that property sub to, is a hybrid deal, and what my end buyer is paying me. I'm making a gap there in interest on money that was originated in the deal. Didn't even come from my bank account. I didn't have to loan it. It was money that was originated in this deal that I'm making interest on, right? Crazy, just like out of thin air. Crazy stuff. Let's look at what this ends up being. So if the mortgage payment is $1,175, principal, interest, taxes, insurance, well, how much is just principal interest? So for this example, I said probably about $275 went to taxes and insurance. So $900 a month is principal interest. Plus I have to pay my seller $100 a month. That ends up being $1,000. Well, guess what? What's $2,200 a month minus $1,000? That's $1,200 a month net cash flow for me not to have to deal with the property, do any repairs, nothing. All that is done by the homeowners. They actually own the property. I'm the lien lord, not the landlord. I own the lien on the property. So let's look at these numbers together. Number one, we have our cash now. In this example, that's $11,000 is what we collected up front. Cash flow, I'm making $1,200 a month net. So on this projection over a 10-year period, I'm going to make $144,000 on this one deal that I found that no one else wanted and I structured on market. I'm going to make $144,000 over a 10-year period. And then I have my cash later, which is the difference between, so in 10 years, when they either, the person that family up here, these folks that I put into the property, when they want to sell the house or they want to move somewhere else or they want to refinance, again, they own the home, they can do whatever they want to do, but they're going to cash me out. Typically, they're going to owe less than what they're going to be selling it for. And they're going to give me a lump sum of cash saying, hey, Matt, thank you so much for the house. We're paying you off. We owe you X amount of money. And in 10 years, they would owe me, it was like 256,000, whatever. It's on the calculator, right? But that's what they would owe me. Once I get that check, I have to go and I have to pay back my original seller and I have to pay back the bank that owns the underlying debt and say, hey, here you guys go. So the difference between what my buyer pays me in a lump sum whenever they either sell it or refinance, again, this is just a projection. They could do this in 7 years. They can do it in 15, whatever. But whenever that does happen, there's going to be a gap between what they owe me and what I owe my underlying debt because of that interest rate that I added into the deal. And in this example, it was $62,650 as the difference. All in all, I would make $217,649 for a deal I had no money in. I didn't have to go out and offer someone 60 cents on the dollar for their house or lowball cash offer. Didn't use any of my money. And over a 10-year period, I make over $200,000 on one deal. What gets really fun is if imagine yourself doing that over and over and over and over. If you just did one of those a month for 12 months, you just added $2.4 million to your net worth in 1 year. And that's just doing one a month. That's craziness. Now, the downside of doing it this way, you don't get depreciation because you sold the property and you don't get the appreciation because you sold the property, right? You don't own it anymore, but you also don't have to worry about repairs. You don't have to worry about scheduled maintenance if the roof falls in, whatever. I don't have to do any of that because I just own the debt. The main thing here for you to understand in 2023, the market's crazy. It's going all over the place. It's up, down, it's sideways. But for those folks that can think a little bit more creative and know where the deals are at, you structure deals just like what we're talking about here. You are going to make more money than you have ever made in your life. And the crazy thing is, it's not that hard. These deals are out there. They're abundant. There's enough for everybody. I promise. In every market, there's homeowners who need to sell that can't. And if you can come in with creative solutions just like this, you're going to make a ton of money. Hopefully you get value from these videos just like this one here today. I'm going to be breaking down even more wrap deals. If you guys want to see that, please comment below that you would like to see it. More than anything, we want to see you guys win here on this channel. So I'm going to be coming out with more videos just like this one, sharing with you guys interesting ways to make even more money this year. And we want you to be successful. So if you haven't already subscribed to the channel, hope you consider doing so. And if you're not in the Facebook group, the Real Estate Circle, we're doing deals just like this every single day. We appreciate you guys so much. Thanks for watching this video. We'll see you next time.